You did not hear it on the evening news. There was no conference, no headlines, no alarms. But in boardrooms and back-end systems, trillions of dollars just moved. Quietly, strategically, permanently. BlackRock, the world's largest asset manager, repositioned over $2 trillion away from U.S. markets. No panic, no prediction, just data, probability, and timing. This was not a collapse. It was a rotation, a redirecting of future wealth. And almost no one noticed. Because when institutions reposition, they do not raise their voice. They run the numbers quietly and move before the world catches on. This is that moment. And if you are still holding yesterday's assumptions, you are already behind it.
Most investors think of companies in terms of products. Apple makes phones, Tesla builds cars, Amazon delivers your packages. But BlackRock? BlackRock does not make anything. BlackRock owns. They are the largest asset manager on Earth, overseeing more than $14 trillion in assets, more than the GDP of China. Think of the entire stock market as a massive apartment complex. Companies are the tenants. Investors are the renters. BlackRock, they are the landlords. Their fingerprints are everywhere, in your 401k, in your pension, in your mutual funds. Even if you have never bought a single share directly, you are likely exposed to BlackRock, indirectly and invisibly. But what makes them unique is not just scale. It is access, timing, influence. Through their proprietary platform, Aladdin, BlackRock runs risk models and market simulations that digest more than 200 million calculations each day. They do not just follow the markets, they help shape them. When politicians draft regulatory policy, they listen to asset managers like BlackRock. When central banks plan interest rates, they consider institutions like BlackRock. When global capital reallocates, BlackRock is often the one pushing the first domino. And unlike the emotional chaos often seen in retail investing, BlackRock's decisions are boring on the surface, slow, quiet, institutional, quantitative. But boring does not mean small. When BlackRock moves money, markets follow. Not because they're loud, but because they rarely miss. This $2 trillion repositioning was not a guess, it was a signal. And if you understand who they are, you understand why we should be watching what they do, not what they say.
It is easy to assume that American markets will always lead. After all, the U.S. has the deepest capital markets, the most powerful tech companies, and a historical track record of resilience. But capital has no passport. It moves where growth can happen, not where it used to happen. Recently, BlackRock rotated over $2 trillion in capital away from U.S.-focused assets and toward emerging international markets. The world's largest asset manager, betting, quietly, that better returns now live outside the borders of the United States. This was not panic. It was not political. It was a shift based on macroeconomic math. The U.S. dollar, while still dominant, has been under pressure. Inflation ate into purchasing power. Policy uncertainty increased volatility. And while American equities still produced decent returns, they were no longer untouchable. In 2023, U.S. markets returned around 16%. Meanwhile, Germany approached 22%, Japan over 26%, some international markets near 30%. The advantage was shrinking, and in some cases, reversing. BlackRock saw the pattern early. Youthful populations, manufacturing expansion, soft currencies, and favorable demographics in emerging markets all pointed to greater upside abroad. Their decision was not a warning siren, it was a rebalancing, a quiet message sent in dollars, not headlines. And for anyone paying attention, it proved a core truth. Global wealth flows are shifting, not out of America entirely, but towards a new balance that better matches tomorrow's opportunities. The dollar is still powerful. The U.S. economy is still influential. But for the first time in a generation, the best growth may no longer be here. And BlackRock, as always, moved first.
Institutions do not wait for the news. They move before it. The average investor reads a headline, feels something, fear or excitement, and reacts. But firms like BlackRock, they act weeks, even months before the headline is written. They are not fortune tellers. They do not have crystal balls. What they have is information and systems built to respond to it. Armies of analysts, access to real-time global economic data, insider policy analysis, and proprietary models like Aladdin allow them to detect trends before they are visible on the surface. By the time retail investors hear about a trend, a spike in emerging markets, a correction in tech, a sudden move into energy, the real opportunity is already priced in. This is not because institutions are hiding anything. It is because they are functioning in a completely different dimension of awareness. And here's the truth most people miss. Institutions rarely follow emotion, they follow probability. When inflation ticks higher, when currencies weaken, when trade policy shifts, the smart money does not argue, it rotates, quietly, systematically. They are not trying to predict what comes next. They are simply aligning their portfolios to what is already underpinning the change. And what makes this rotation extraordinary is not just how much capital moved, but how little attention it received. BlackRock's $2 trillion shift out of U.S. exposure was not a statement, it was a signal. But if you were waiting for someone to explain it to you on the news, you were already too late. Because smart capital does not explain. It moves. And if you want to understand where wealth goes next, you have to learn to watch the footprints, not the forecasts.
Most investors hear foreign markets and feel uncomfortable. Language barriers, volatility, unknown risks. But discomfort does not mean danger. Sometimes it just means unexplored opportunity. BlackRock's $2 trillion rotation was not an exit. It was a realignment toward growth the average investor is missing. And that growth is accelerating, just not always here. Let us break down where the smart money is going. First, VWO, Vanguard Emerging Markets ETF. This fund gives exposure to some of the fastest growing economies on Earth: China, India, Brazil, Taiwan. What do they have in common? Demographics. In the United States, the population is aging. In many emerging markets, it is just getting started. Younger workers, expanding consumer bases, cities still being built. These are engines for long-term growth. Last year, VWO returned around 25%, and while it is running quietly now, that is exactly the environment where institutions like to accumulate before momentum becomes visible. Buying VWO today is not a bet. It's long-term positioning, like buying broad U.S. indexes in the 1990s before they became obvious winners. Second, EWJ, Japan ETF. For decades, Japan was dismissed as stagnant, but that was the old Japan. The new Japan is under structural transformation. Corporate governance reforms have made companies more shareholder-friendly. The yen is weak, which benefits exports, and Japan remains home to some of the most respected global brands like Toyota, Sony, and Nintendo. At one point, EWJ returned 71% year-to-date. The headlines barely noticed. Smart Capital did. Third, EEM, iShares Emerging Markets ETF. This is a broader approach. EEM spreads exposure across regions and economies, giving access to diversified momentum beyond any single nation's risks. If the next decade belongs to global growth outside of traditional Western power centers, EEM is the entry pass. This is not about abandoning domestic stocks. It is about accepting that opportunities no longer sit in one country. Growth is moving to new populations, new systems, new frontiers. The question now is not whether to be global, it is whether you will be late.
Every cycle, it happens. The market dips, bad headlines appear, volatility returns. Retail investors panic. They sell low, then watch prices recover without them. Over time, they do not learn, because the problem is not intelligence, the problem is timing. The average investor waits for things to feel safe. They want confirmation, clear skies, good news, green lights. But by the time it feels safe, the opportunity is already gone. Institutions are not emotionally reactive. They are mechanically prepared. They do not chase headlines. They chase probability. Retail investors ask, what if this gets worse? Professionals ask, what is the risk if I do nothing? And here's the hard truth. Certainty is one of the most expensive things in finance because it only appears after the return is gone. When markets are fearful, most people freeze. Smart money moves, not recklessly, but calmly, strategically, based on what the data actually shows. That is why BlackRock shifted $2 trillion before the headlines understood it. And it is why those who wait until it is obvious will find themselves buying after the easy gains have already been taken. This is not about bravado or being first. It is about refusing to be last. Discomfort often comes just before the story changes, but if you only act when discomfort disappears, you are always watching the wealth move without you.
Wealth does not vanish. It migrates. It leaves frantic hands and finds steadier ones. It trades fear for foresight, emotion for endurance. The largest asset manager on earth does not panic, it rotates. And right now, that rotation has already begun. BlackRock's $2 trillion move was not an accident, a theory, or a reaction. It was a strategic repositioning based on cold math, forward-looking trends, and quiet confidence. Most people never notice when that kind of shift takes place. It is not supposed to be visible. That is how smart money works, silently, early, and without permission. But you are not most people. Now you know where the capital is going. You know why it is moving. You know what tends to happen after decisions like this are made. Not overnight, but inevitably over time. This is not a warning of collapse. It is a reminder of change. You do not need forecasts. You do not need perfection. You just need to stop waiting for someone to tell you what already happened. Because by the time the talking heads start talking, the wealth will have already moved. So follow the quiet money. It is never yelling, but it is always a few steps ahead.